Hi, and welcome to Human Financial's Market Briefs. Three things are building at once right now, and I want to talk about all of them because they share a common thread that I think is worth understanding before any one of them arrives fully formed. The first is out over the Pacific. Sea surface temperatures are running at more than 3 degrees above normal, tracking towards an El Nino event that could rival or exceed the 1997 occurrence. I'm not here to talk about weather for its own sake. I'm here to talk about what El Nino does to food prices, to agricultural supply chains, and to energy demand, and to inflation. The 1997 event contributed to commodity dislocations that took years to fully work through. Eastern Australian droughts, Californian flooding, and disrupted food harvests across Southeast Asia. These are economic events dressed up in meteorological clothing. When food production falls in a world already running elevated grocery prices, the consequences lead directly to household budgets and to central bank decisions. That's not an abstract risk. It's a live input into the inflation outlook, which is a live input into interest rates, bond markets, and the valuation of virtually every asset class you own. Now, the second is in Silicon Valley. SpaceX, OpenAI, and Anthropic, three of the most discussed private companies in the world, are circling the public markets. Their valuations run into the trillions of dollars before a single share is traded on an exchange. There is a concept borrowed loosely from statistics, the law of large numbers, and that applies with uncomfortable directness to this moment. The academic work is clear. Stocks entering the top cohort of global market capitalization tend to underperform the broader market over the following decade. Not because the businesses are bad, because the price already assumes that nothing goes wrong. The venture capitalists got in early, the sovereign wealth funds got in early, the employees who held through the lean years got in early. And now the public market investor is being asked to fund the next chapter, which has to be even more extraordinary than the last to justify the entry price. That's a high bar, and market history of companies priced to perfection is not encouraging. And the third is closer to home. 2 weeks ago, the federal budget announced what amounts to the most significant change in Australian tax regime in a generation. From 1 July 27, the 50% CGT discount is gone. It's replaced with a cost-based indexation and a 30% minimum tax on realised gains. Pre-CGT assets held in some cases for 40 years under the assumption of perpetual exemption are being brought into the net. Negative gearing on established property is being wound back. While these changes are not yet law, and they may be amended, but the direction is clear, and the implications for investment structures built around the old rules are real and in some cases substantial. For advisors with clients holding long duration assets, property, unlisted investments, pre-CGT company shares, the clock that starts in 2027 has already started. Now here is the thread connecting all three. In each case, the thing that makes them consequential is not whether it happens, is that it's already happening in slow motion before people have had time to adjust their positions. El Nino doesn't announce that it's hit landfall. Mega cap IPOs will not wait for you to finish your due diligence, and CGT changes will not pause for investors who assumed the rules were permanent. We've been positioned for exactly this type of environment. Not because we predicted these three specific events, because we don't think you need to in order to prepare for them. Our portfolios are diversified across asset classes, geographies, and sectors as a structural defense against concentration risk that hasn't revealed itself. In our dynamic portfolios specifically, we are underweight growth, a deliberate call made before the mega cap IPO cycle peaks and before higher for longer rates finish working through the growth valuation. It's not a popular position to have when markets are running hard, but it tends to look very sensible in the months that follow. We'll keep monitoring all three of these developments closely, but the right response to a world where multiple significant forces are building simultaneously is not to wait for certainty. Certainty arrives after the opportunity has passed. Being early and being diversified remain the most durable ways to protect and grow capital your clients have entrusted to us. Thanks for tuning in.